All right, so a lot of people just learned a investing principle the hard way, or I mean, they're about to learn it if they haven't figured it out by now. Walgreens slashes dividend by almost half. Walgreens dividend cut puts its membership in the dividend aristocrats list in doubt. So again, Walgreens Boots Alliance stock tumbled Thursday after the pharmacy chain slashed its dividend by almost half. The move puts the company at risk of becoming removed from the S&P 500 dividend aristocrats, an index of S&P 500 companies that have raised their dividend for at least 25 consecutive years. At its old dividend level, Walgreens had one of the highest dividends in the S&P, but that's about to change. The company announced a quarterly dividend of 25 cents on Thursday, down from its previous quarter of 48 cents. Again, it's payable on March 12th. Again, so what is the point I'm trying to make here? In that there's a lot of people out there, a lot of investors out there that chase dividend yields, right? They see this 7, 8, 9, 10, 11, 12%, whatever the number is, and they think, oh my God, I'm going to get this guaranteed return, but they don't dig deeper. And what do I mean by that? You have to make sure that the dividend is sustainable. And what do I mean by that? When you look at Walgreens, the dividend clearly was not sustainable, right? Clearly was not sustainable, right? I mean, if you look at their current free cash flow yield, it's not even 1%. Like it's not even 1%, right? So, I mean, if anything, this dividend probably is going to come down even more, if anything, right? So again, a lot of people will, maybe they picked it up when they had this recent pullback, thinking that, oh my God, I'm getting all this value, when in reality you're not, right? So again, this is another mistake a lot of people make. They see a low PE or a stock that's quote unquote cheap, and they buy it thinking, oh my God, I'm the next Warren Buffett. Like, no, you're not. So again, let's look at some of the red flags here. Again, first thing being, again, growth, absolutely horrible, right? I mean, operating cash flow is going down 42%. Net income down 172%. I mean, financial health, this company has a very poor current ratio, only 0.63%. If you look at the management, again, stock-based compensation is extremely concerning. Profitability, they have a negative net margin. Like, that is extremely, extremely concerning, right? A negative net margin. A price to free cash flow, again, extremely expensive, but that's because they're losing money, right? So again, let's look at the dividend here again, right? So again, 48 cents, again, they've grown it for an extremely, extremely long amount of time. But again, you look at the payout ratio. Again, the payout ratio was 1,100%. It doesn't take a genius to figure out that dividend is not sustainable. And again, it's not like something very recently happened. I mean, Walgreens has been in this tailspin for a year, even upwards of 2 years, even. Like, I mean, let's look at the stock over the last year, right? Again, it's just lower lows, and I mean, it's came up quite a bit from its bottom back in the end of November. But again, nothing fundamental here is pointing towards a massive resurgence over the long run, right? I mean, it's still down, even at its peak. Even at its peak, it was down 29% on the year, right? Right now it's down about 34, right? So this is something that, again, you really got to watch out for. You really, really need to watch out for, because again, people got caught chasing this. Oh my God, it's a 7.7% dividend. I'm gonna get this guaranteed return, but no, you're really not. And again, on top of that, who cares about how good the dividend is if you're losing money compared to the market? Like, who cares? Right? I mean, if we go back, let's go back to 2020 here just to see. This company has negative returns, right? Ever since 2020, this company is down 34% when you include dividends, right? Let's go back to 2021. It's down 36% when you include dividends. Right, even over the last year. Let's even look just the last year. Down 33%. Right, so again, it boggles my mind why people invest in these kinds of companies. Right? I'm not saying they can't turn it around or they for sure won't turn it around, but if you're setting odds, the odds are heavily in favor that this company, not only is it probably isn't even going to have positive returns, but 99% chance a company like this underperforms the market. Like 99% chance. Right? So again, stop chasing yield because, and again, a lot of people probably say, oh, well, I want income. I'm looking for income. And it's like, number one, the amount of people I see that say that are like 25, 30, 35 years old, honestly, the majority of the people I hear are like that age. So it's like, okay, well, you still got a lot of time before you're going to retire. Even if you're going to retire early, why are you worried about income when you're just underperforming? Right? I mean, QYLD is a good example of this, right? Again, they're not as bad as Walgreens or as bad as some, but again, you still look at their returns. I mean, this company came out in 2014. They returned 57%, including dividends, over that time. I mean, the share price returns are negative. Right? So again, why would you make these investments when you're grossly underperforming the market? Like, you're grossly underperforming the market. And not only that, the dividend, like the amount they're actually paying, has gone down over the last 5 years. Right? So I don't know why so many people invest in these kind of companies, right? One of the fundamental things that I have when it comes to investing is, again, you want to be overperforming the market. Right? And again, it's very easy to see. Just compare it. Just compare it. If you look on Stock Unlock here, they even show you when you include dividends, because I know a lot of people say, oh yeah, the share price is going nowhere, but when you include dividends, it's like, okay, well, most of them, that the answer to that is no. So that's a very important concept for a lot of people to understand. And again, most people probably know this, but there's a lot of newer investors, even a lot of intermediate investors that don't see this. Right? So the point is very simple. Stop chasing yield. Stop chasing yield. If you want income, sell your own covered calls. This is another thing that really kind of doesn't really make sense to me, is that it's as easy as ever to do this stuff yourself. This is why it boggles my mind why people pay other people to manage their money. It's like, it's as easy as ever to do this stuff yourself. As easy as it's ever been. Like, by far. I hear a lot of people say, oh my God, there is record amounts of people invested in the stock market, and this is, and they talk about it like it's a bad thing, which is like, number one, why is it a bad thing when the stock market has been one of the most predictable over the long run ways to generate wealth we've ever seen? And number two, it's like, okay, well, it's easier than ever. That's like saying, oh my God, it's the record amount of people have TVs going compared to 50 years ago. It's like, yeah, well, anyone with 2 brain cells can figure that out. Right? I mean, when you have apps where you can literally link your bank account and have the money come out automatically, like you could have your investing app, whoever, whatever it is, you can link your bank account, say, I want to take out X amount of money per week, per month, and just reinvest dividends. You could literally set that up one time and literally do nothing for 30 years and be fine. Right? You could do nothing. That's how easy it is. Now again, that's a little bit different of a topic than my original one I was talking about. But again, I just wanted to make the point that it's easy as ever. And another way of looking at that too is that finding data is as easy as ever. Right? Look at platforms like this. Again, the advanced nature of some of the platforms that we have access to now is extremely good. Like, you can see all this stuff in plain English that anyone can understand. At least anyone that's willing to put in even a minutia amount of work. Right? So again, like I mentioned off the start, don't chase yield. And if you see a company with a high dividend, check and see. Is the payout ratio concerning? Again, like when you look at when you look at some of my favorite dividend companies, I mean, let's just look at EQB, right? This is a pretty good example of it, an easy example to understand here. Again, you look at the numbers here. Again, growth is very good, financial health is good, profitability is good, management is good, valuation. Again, that's another thing to keep in mind too. A lot of people pay too much for companies, right? So you've got to keep an eye on those valuations. But again, when it comes to the dividend, again, this is very, very, very simple to understand. Again, look at the payout ratio. And if it's some companies, you're better off to go on free cash flow. Some you're better off to go on just the regular ass payout ratio. Kind of depends. That's a little bit more advanced, but usually they're fairly similar anyway, so it's not that big of a deal. But again, you look at EQB, 14% payout ratio. That means that the dividend is very, very sustainable. When you have these companies that have these 70, 80, 90, 100% payout ratios, unless they're a REIT, because REITs are different. But again, that is a very, very concerning amount of payout, because if earnings go down, even a small amount, they're not going to be able to pay that dividend without issuing shares or taking on debt. And that's the last thing that I'll leave it on here too, is that a lot of these companies, like a lot of these BDCs and mortgage REITs, they pay out these 10, 11, 12% dividend yields. And again, they're consistently doing it, and they're actually getting half decent returns, but they're taking on debt and they're issuing shares. And if a company's doing that, they're literally using your money to pay you back your own money. You're not getting anywhere. So that's another thing to keep an eye on. Again, make sure the companies you're buying are not taking on excess amounts of debt and not issuing shares, perpetually issuing shares, because that's a massive red flag. So anyway, that's what I wanted to bring up today. If you liked the video, hit that like and subscribe, and stay tuned for more, and comment and all that good stuff.